Sold at 560.
785 the first, 785 the second, be sure, 785 the third, the final time, sold. The third and final time at £910,000, sold. Welcome everybody to the latest edition of the Allsop Prop Chat. My name's George Walker, I'm one of the commercial auctioneers, and I'm joined today by my partner Richard Adamson, a fellow auctioneer, and Anthony Hart has come all the way down from Leeds. He got here with 5 minutes to spare. So Harty, good morning and welcome.
Thank you, George.
This podcast will cover how did we raise £100 million in the last two auctions, but both residential and commercial. But also, more importantly, what's driving those buyers and sellers? Is this the right time to buy? Who knows? We'll try and answer that. How does the rest of the year look? Obviously, you'd expect us to look ahead a little bit. But with our special guest, Anthony, today, we're going to bring in and apply some of the principles of what we've seen in the auction room to student. Why would you consider adding student to your portfolio mix? Because it's different, it's a growing sector, and obviously we're quite good at it. So Anthony has a view on that. How was your September sale, Richard?
Morning, George. How was the September sale? It was a 3-day marathon sale, which, it was. So, we catalogued 505 lots over 3 days, one of which was in the room, which was an awful lot of fun, and then 2 days live streamed from our office. So
you were a real live auctioneer again, waving your arms around.
Yeah, 3 days of being a real auctioneer, which was great fun. And it's as I say, it's been a marathon, blood, sweat and tears. The market is challenging, but what we've certainly demonstrated for us raising 65 million in three days and coupled with you guys totaling that to 100 million, there is a market there. And we always say this, it's a price sensitivity point. And if you get the pricing right and you get vendors that are committed to the process and trust it and price it right, there are buyers out there for the weird and wonderful things all over the country.
I mean, you had 3 days. Did you classic Allsop variety of stock, probably from 2 million, or actually you had 4 million down, 4 million out of 40,000. How did you spread it over the 3 days?
Well, believe it or not, in terms of the pricing, we sold a lot for £50. And we sold a lot for £4.2 million.
That's quite low.
Yeah, so it was the weird and the one and everything. In terms of how we split the auction up, we went geographically. So day one was predominantly, depending on where you draw the line, London and the South East.
The £50, does our system allow for that?
Yeah, and what was it?
It was a parking space.
Of course it was.
It was a parking space in South East London.
Right.
Well, you'd think so, wouldn't you? But yes. I mean, it's the weird, the wonderful, and every single price there, and it was nationwide. So 505 lots. Day one was predominantly London and the South East, if you call Luton London, and then down from there, and then the days 2 and 3 were North East and North West.
Okay. Any common themes? Just loads of buyers. What's the numbers of buyers you get registered for 505 lots?
Well, I have to say, we as you do the same, I know, we do really analyse the data in terms of how many people are in the market. And as you'd expect, the more lots you have, you should have more people buying by virtue of that.
So like us, I mean, you can see at any one point how many registered buyers there are. They all paid you £10,000 for the right to bid.
Exactly.
So what was it looking like?
So we had day one was about 700. Which is higher than we've had probably for 12 months for one day. Day 2 and day 3 together was 1,600. So it's a lot of people registered to bid. In terms of common themes, day 2 and day 3, by virtue of location to a degree, was lower value stuff. And those buyer pools, as you might expect at times like this, are deeper than when you go further up the food chain.
When it's a couple 100,000, there's lots more people.
There is, yeah. And predominantly a lot of the stuff we were selling was vacant houses, and therefore it will appeal to large investors that want to have big portfolios and already do, but also new entrants or smaller vendors that want to buy up as well.
You mentioned you actually did sell one or two to people who want to live in it, which is...
Yeah, we still do get people that will come into the market as end users. That hasn't changed. It's probably not as much as it was a year or 2 years ago, but they're still there.
And how many people are building up a portfolio straight from the auction room, buying more than one lot? I mean...
Quite a few. We had a lot of multiple bidders, a lot of people. We had quite a lot of concentration in certain areas. So 20 houses in Derby, 20 houses in Northampton, 20 houses in Luton. So we've built up a really, really good database of buyers. Precisely. But equally, there were buyers coming from London and other areas because the pricing was right, were prepared to go elsewhere and go to places they wouldn't go.
I mean, it's what I'm finding increasingly with our market. It's just deal-driven. People does the deal work now? And discuss. Doesn't matter where it is.
Yeah, and also going back to the, if there's an opportunity in this market to buy something and add value to it, whether it's just basic stuff like a refurb of a house or extension of a lease or planning gain, that is still really appealing to people. And for obvious reasons, it's a good time to be tying yourself up with adding value.
And one thing that we found with pricing is that I think you do a great deal more overage than we do because it's quite hard to value these houses. But looking at the pricing, where vendors are realistic, you do get the overage. I mean, that's the key to auctions working, isn't it?
It is. And it's such a cliche, and it's easy for auctioneers to say to sellers because it's not our money. But if you have two identical assets, one guided at 250 and one guided at 350, the one for 250 will sell for more. It generates that market, it generates that excitement, it shows commitment to the sales process, and it works every time. But I fully accept that's easier said than done. We've got vendors at the moment that are happy to be led by the market, and that makes the job easier. It's still tough, but it makes the job easier in generating interest.
Auction has been banging on about this since time immemorial, I think.
Absolutely right.
But I've done some analysis in our auction room. The top 5 most popular lots, we had the most popular 15 registered bidders. It's not like you and you have 46 registered bidders. But, 15 was the most registered bidders, and the average overage in that top 5 was about 140% of the original guide price because the vendors were happy to take the price and they weren't receivers. Only one receivership sale in there. But what's interesting is going across the sectors, there's no commonality. Care homes, convenience store, bedding shop, in tool station in Lewisham, dentists. It is the only common theme is the vendors are saying, right, I do want to sell it. I want to sell it now. Therefore, we get a dozen people registered to bid. And that's as common. And people say that's what receivers do. Well, actually, it's what savvy sellers do. And that's kind of needed in our market.
What I would like to know is, in terms of yields, there's always been, I've listened to you guys and read obviously what you write and what happens in senior results, a disparity between different sectors in terms of yield. Is there sort of flight to quality now that yields are similar in different sectors? It's all about the covenant.
I think we did an article 12 months ago, it's not all about yield. And I think even more now it's about the real estate. You used to have low yields high street, low yields out of town. Offices would get a bit stronger. Then industrials beat the whole thing and came down to 3.5%. So the yields made up of so many things, it's actually quite hard to judge. Basically, in our market, what people have as an option is 6.2% from national savings for 12 months, guaranteed by the government as much as you want. So the marker for us is you've got to be 7.5% is where people start looking because that is a bit of a risk premium. So in any sector, that's important. Clearly, if it's a cost of coffee and 40 years outside town with an RPI increase, they'll pay more than that. But if it's an office building which is multi-let in, tertiary part or secondary part of the country, they want a lot more yield to play for the risk. That's as simple as that. And we see yields much higher than you do in your market.
So the days of anything below 5% period are not there.
Pretty thin. We had a couple of lots below 5%. They were pretty small and very, very long loan. But we now have 5.5%, 6% is what we think is punchy yield. So I think the most the dentists we had in last auction, 10 dentists, all on long leases, that was average 5.8%. So the buyers are thinking, well, the rent's going to grow. And in that case, the rent looks like they will grow. They're very decent buildings. They're modest rents. So there's a rent review to be had. So then they get the yield above that 5.8%. But 6.5% is a kind of marker. And each sector really has to be defined by that. To get below that is pretty punchy.
Although our markets are very different at times, the same sentiment is there for us. And I think I might have said it before, but in London and the South East, and the more prime you get, over the past decade, investors have comfortably accepted really low yields. One, because their borrowing costs are very low, but two, because they were, certainly in London South East, were expecting pretty good capital growth over a period of time.
Yeah, but if you've had anything residential the last 30 years, you've seen capital growth. For every 5-year period, you've seen capital growth. And there's the difference. So you may only have a 2 or 3 year, 2 or 3% return on your flat in Waterloo, but it's gone up by 5% every
Absolutely
year.
right.
So
that's where it's shifted now for us, is that at this moment in time, and obviously everyone tries to forecast a little bit, is that your borrowing costs are above 5%, so why would you take a yield at that level unless you're getting capital growth, which you're not necessarily, or certainly not at the rates you were before. So we're feeling the same sort of, when we're looking at stuff and people saying, well, 2 years ago I was going to get 5% for that AST or that block. You said, well, actually, it's now you're doing well for 7.5%. So it has really shifted in our market.
I think the one big difference before we come on to the student sector is that a vacant commercial letting, it's very, very hard to put a number on what it's worth. But clearly, a flat everywhere in the UK has got a tenant waiting to occupy it. So, there's a big difference. Good time here to introduce Anthony. So, you're based in Leeds. You cover the UK, I think.
We do, yeah. Well, I think anyway from Dundee. We've sold in Dundee and all the way down to
Still
South
in the
Coast.
UK?
Yeah, and Southampton. So all over the place, yeah.
You must do some miles.
Falmouth, Exeter. We do, yeah. We do some miles. Yeah.
So what's the lot size? What sort of yields are we talking?
For us, I mean, we place ourselves in a market where we're quite happy to do some smaller lot sizes, those being 5 million to say 20, 25 million, which in our space is actually smaller lot sizes than say average. Most 200-300 bed buildings 50 plus million. So actually we're quite happy in that space. With our business at Allsop, we have a good ability to tap into that investor.
You advise people as well in terms of actually from building from the ground up, to get the end product right for the investor.
Yeah, which is challenging at the moment, right?
Yeah, I bet.
Because so crucified by build costs, I assume.
We are, which has a massive effect on the sector, because then it affects affordability for the student as well. Because of course, to get development appraisal stack at the moment, we're having to push rents.
And what's the sort of history for 10 years in per space in Newcastle? Where's the rent? Is it just chipped up every year?
Well, last year, from the 2022-23 academic year to this current academic year, Newcastle, for instance, saw, no notes, by the way, 12% uplift in rents.
Did it really?
Yeah, so double-digit uplift in rents.
Is that the same across the country?
It's not, no. Actually, in some markets, you've seen negative. It's an interesting topic of conversation, actually, because people talk about student accommodation as if there's demand and rental growth everywhere. But in actual fact, it's more nuanced. Some markets, I'm not afraid of saying, that they are oversupplied at the moment. Therefore, the competition for beds is high, and therefore operators,
competition
investors,
for tenants
is
high.
Yeah.
So go on then, 1 or 2 towns? Don't you say it?
Yeah, top 2, bottom 2.
Oh, goodness me, I don't like doing that. Bristol, top 2, with Edinburgh probably.
The top 2 in terms of demand, rental improving.
And Glasgow, Manchester, Newcastle, they're all up there at the moment. And then bottom, you don't want to do this to me. Places,
That's what you're here for.
There's a lot of talk about Coventry at the moment. But Coventry's got good student numbers and good student growth in terms of both universities in Warwick and University of Coventry itself. However, what happened there was it's just suffering some indigestion. Too many purpose-built student beds delivered at the same time. And when you find this across the country, where you've got cities like Coventry, and there are others, where you've got good availability of land and student accommodation feels like an easy option, you do get a situation where there's a lot in the planning pipeline and a lot delivered.
So how specialist is it? If you're going to put 25 million into a student setup, and I always think it's dominated by corporates. If you look at Richard's clients and my clients, they've got portfolios, they're really good at managing that. Do you build a block and get it let to one operator, or does it? How many of these bigger schemes are direct?
Okay, so to answer your first question, the sector is very diverse, it's very mature. So we deal with a lot of high net worths and families who have delivered smaller schemes of say 50, 60, 70 beds in a given town or city.
And are those people with 50 beds randomly take a town extra? Yeah. Have they let it to one person?
No, so what they generally do is they appoint a manager or operator.
On site?
Yeah, on site, who does the day-to-day operating and letting of the building. But it's what we call direct let mostly. The student sector is every year, every cycle, you let your bedrooms.
And so that building has its own website, own booking facility, local manager, the whole thing?
Yeah, and sometimes for a larger scheme, for example, or even some smaller schemes, you might deploy a national operator, the likes of Homes to Student, CRM, Host, there's lots of them.
Yeah, we know nothing about that.
And how does that impact, obviously, netting down the rent? So what sort of charge does that cost?
So, typically, the higher your rental tone, sort of lower gross to net. So, it generally costs very similar amounts of money to operate a student accommodation bed. So if you're running at sort of £300 a week building, which nationally it would be quite a high rent, then it might cost you a little bit more to operate that building because you might be providing some more services to the students. But generally speaking, it's the same if you're getting paid 90 quid for a room elsewhere.
Is it really?
Because you're paying the utility cost, which is the main driver of the cost.
So the community charge, the individual tenants pay that?
Yeah.
So as a landlord, you're paying utilities?
Yeah.
Management?
Yeah.
Insurance?
Yeah.
So it's like an AST type of thing.
Yeah.
You mentioned other services.
Yeah.
You're talking snooker halls and vending machines.
I am, yeah.
Really?
So, if you're paying
your pot noodle vending machine.
300. Oh, you should see some of these student schemes now. I've seen glamping pods.
What?
Yeah. Slides. Yeah. Within the communal spaces. If you want to go from one level to the other, you can slide down to the ground floor. Your cinemas now is can be quite a common.
Or is that standard?
Pretty much, yeah. Good standard as well. Even things like recording studios, and you see all sorts.
Are they sort of cluster flats? I remember being cluster flats with shared facilities. Is it still a similar setup where you have many communities within the building that are sharing some communal space?
Yeah. Well, I think I want to touch on that actually, because that's kind of an important point. Because one of the questions I get often asked is, I'm looking at developing some student accommodation. Should I build studios, or should I build non-ensuite clusters or cluster accommodations, or studios they call them now, where I won't go into it, but there's such a thing.
That's what we're here for. What's a studio?
It's essentially 2 small studios, and then you have a sort of open lounge area as well to share. The answer to that question is that yes, they still do exist. And really, when you're looking at building student accommodation or developing student accommodation designing, you need to think about the university, and you need to think about the demographics of the university, and you need to think about where the students are coming from. So, for example, if your universities are heavily domestic students, then you might look at investing in HMOs, for example, or you might look at investing in cluster flats, as you said, maybe with ensuite accommodation, because they're at a slightly lower price point. But if you're looking at investing in a university where there's high numbers of international students, then we see lots of studio accommodation, even 1-bed apartments.
Because they want a bit more perfect.
Because they want a bit more privacy that services that clientele well. So it's horses for courses, right? You've got to really understand the market that you're delivering into and what that market needs at that point in time. It's a mature market, so you need to look at what already exists in that town or city, what it's missing, where's the growth in the student numbers, what demographic is growing here. What courses do they do? All sorts of things you need to consider.
So it's not unlike office or a shop. Just where's the demand, but where's the rental growth coming from? So the actual operating that isn't so difficult, but it does probably imply a local manager, doesn't it, when you get to any scale?
But going back to, it's my ignorance, but in terms of if you're looking at a total rent of a building, I appreciate it's a sliding scale depending on how much the manager's doing.
Sorry.
Well, if you've got a £500,000 rent coming in gross. What's the sliding scale of what that nets back to?
Yeah, so say if you're renting your building for, say, 85, 90 quid a week, then you're probably 50% gross to net.
Really?
No one likes to talk about that, but that's just the truth. Because it comes back to my point that utility costs aren't any different to managing a building.
So you need to be a bit more prime. Start with a 3.
Yeah, I mean, well, you just need to consider that when we consider that when we're pricing, right? But as an average, it's probably somewhere between 25 and 30%. As an average, as a sort of ballpark figure. And operating costs are generally somewhere around £2,500 a bed. If you're going to put me on the spot, that's kind of where we are.
So something else you've avoided brilliantly is the kind of yield. What net yield can you expect? I mean, if you're putting 25 million into the sector.
Yeah, so we've seen a switch, I think, recently. So for an institutional product, by that I mean, something with scale, 250, 300 beds, delivered within the last sort of 5 years, meets all the regular new building regulations, etc. Something that's very clean and a good city. We probably haven't seen that significant of a yield shift. We were probably somewhere around the 5% mark net of all costs. If you were to give me a prime building in a prime city right now, say 300 beds, I don't think we'd be too far from that now. I think it's still 5.25. And that's driven by the fact that there is not a huge availability of stock at the moment. Last year, the sector did about £7.5 billion of the transactions. This year, that'll be half. Right, so you're not seeing as many good quality operational assets come into market.
Not many of our buyers. You're sitting in a room with 2 scruffy auctioneers. Okay?
Yeah.
So not many of our guys are going to be wielding 300 million. So when they're at 25 mil and it's in Exeter.
Yeah. Okay. So then
where did your yield skyrocket?
We are starting to see those yields push out, and herein lies, I think, a very good opportunity. You could buy a 100-bed building next door to a 300-bed building, and I reckon you could probably get the 100-bed building, pick it up for 7% net, close to, and your 300-bed building still sits at 5%.
So the right time to buy. He said it here.
Well, I think the opportunity is, okay, this sector seems mad about scale. It's all about quantum, but why not do quantum in a different way and buy some smaller buildings where you can
diversify the risk a bit?
Yeah, exactly. Yeah,
that's interesting because you and I have done some work together before.
We have.
In particular, we earlier this year, I forget the exact month it was, but we sold 2 buildings in Leicester, which were, I suppose you'd probably call sort of tertiary student, but they were more HMO styles, period buildings that were converted nicely.
Yeah.
And they've, top of my head, were broadly, I'm looking at gross, were broadly around about bang on 10% gross.
Yeah.
Which, if you're saying 30% is coming off that,
25 or 30%.
It does show that.
Yeah.
And that sector is our sector as well as yours.
Yeah.
And that does still seem to be, now that was bought by a local dentist in Leicester that spent £2.4 million because he wanted some income and wanted to take his money out of the bank because of inflation and whatnot. So there is a crossover there without question. And in terms of going back a bit, and I know it's not that nice to talk about, but what happened during COVID? Was it a bump in the road for you? Did the market change forever? Did what students want change as a consequence of that? How did that impact, and what are the repercussions now?
Listen, from an agent's perspective, it was all the deals that we were working on stopped, and everyone didn't lose sight of the fact that the macroeconomics around student remained strong, and that the reasons for buying that building hadn't changed. But the focus immediately became on, operationally, we need to look after the students that are in situ at the moment. So there was a big focus from all the businesses that we were dealing with and all the people that we were dealing with at the time to the students themselves. And when this is secondary now, we need to deal with and making sure that we're looking after our tenants. And I think that what the outcome of that has been, we've probably seen an enhanced environment for students in terms of how these buildings are operated and the care that's taken and the well-being.
Actually, so the tenant has won out. Right?
I think so. Yeah, I think there's been a lot of focus on that since COVID, and I think that's probably one of the positives that has come out of it.
But the overseas market is still pretty strong.
The overseas market is very strong.
Yeah.
I think
for overseas students, I mean, that's...
Yeah, naturally you're always just, exposed to political events. And, if you're if you're a higher specification building and you're trying to attract, say, for example, Chinese students, Middle Eastern students who generally speaking have the highest budgets, then you are exposed to that political environment. But we don't see the growth in those numbers slowing. The growth in Chinese student numbers is particularly strong. And, that does drive quite a lot of investment into the sector. It really does.
It will do. And they like a particular type of product. Good. Mm-hmm. Okay, well, that's really useful. We learned a lot there. Perhaps time we should cover our market. What's it going to look like rest of the year? How's it going to be?
How's it going to be?
Another 505 at the auction, Richard?
Crystal ball.
Possibly. Next auction's the 2nd of November, and we're putting that together now, and that could be quite a big one, 2, maybe 3 days. So watch this space. How do I see it? I think much of the same. I think much like your market, there's been a lot of investors waiting for, the market to settle. Yeah. And what I mean by that is that, and a lot of people are saying this, is that when interest rates stop, or we feel they're close to stopping and they're plateauing a little bit, granted it impacts the market, but at least you've got a base point to start from. And I feel like a lot of people are waiting to see, is it the bottom
Hart
of the market?
Said, although he didn't think he sold it, this is now the right time to buy.
Put me on the spot.
Your market?
I do think it is. I think it feels to me, compared to August and the middle of summer, that there are more buyers in the market. We are getting more realistic vendors as a consequence. Yeah. And that's the equilibrium you want. Vendors becoming more realistic, buyers getting back in the market, and I feel like we're there now. Yeah. So I think it is a good time to buy. You can never call the market top or bottom at the right time, but I think it's a good time to buy. There's opportunity there. And as you said earlier, George, rents are going up. House building has come to a grinding halt. We've got a problem in this country with housing. So logic would suggest there's going to be a demand, whether it's for owner occupation or it's for investors to let them out. And that will never change.
And that's the same with us. I mean, we're not delivering it anywhere near enough student accommodation beds as we need to be to service demand. I said earlier it's nuanced. There's different areas of the country that differ. But generally speaking, that's true. And therefore, what's going to happen? Rents will grow.
Rents will grow.
Rents will grow.
Well, I mean, the commercial market is I think that the sellers aren't quite there in terms of accepting. They're not all as a mass there accepting the price. The difference, of course, is that when you've got a long lease on a building and you've got debt to pay, if the rent's coming in, tenants have stopped going bust largely. Obviously, we've just had Wilco's, but that's been rumbling for 2 years. The failure rate has subsided, so rents are going to keep ticking along. Nice to hear rental growth talked about in the room from you two fellows. It's not quite as strong in our market, and there are bits where obviously rents are falling. But the retail rent, our meat and drink, that seems to be pretty solid. And everyone who has a retail portfolio seems to be reporting that they can get these buildings let. but there isn't as much pressure when you've got income coming in on a 5-year lease to get things sold. I think it'll happen. People will slightly fall out of love with things, move them on as everyone rationalises the portfolio every year anyway. So there will be those moments, and I think our market's just about getting to the point where people are saying, well, okay, it wasn't the same price it was in May 23. What's it now, and what can you get for it? And as we've seen, my little analysis of the 5 most popular lots, it's all about getting the pricing right to start with. If you show intent as a seller, you'll get competition. And if you get half a dozen people bidding against each other, you get an exit price. And I think that I challenge anyone to look at the 5 examples from the last auction going back. I think the pricing goes back pre-truss. Remember that September last year, the pricing is as good as it was in the middle of 22, where vendors have said, right, I want this sold. You get half a dozen people bidding against each other, and those exit prices are very, very solid.
What kind of buildings were in the top 5 of the most popular?
Well, I think that's the point. When I analysed there's no consistency, right, which is actually, we'd normally bang on about retail yields or the drive-throughs being in the most popular sector. There isn't really consistency except for the sellers who said, right, I want to sell it. So the dentists all had long leases. I suppose the dentist had very long lease, 2036. There was a child's care home which had another 29 years unexpired on a lease, annual RPI, so there's a commonality there. The dentist is a relatively modest lot size, £750,000. In Lewisham in London, City Corporation sold a big building, and people love buying off those institutions. They always feel they can get ahead. They hasn't been managed the way as it could have been. 6 flats to let in a rising rental market in London. That was a £2 million, £2,050,000 sale. So that was a very solid sale. It's where people feel comfortable. And all those bits of real estate were, a little industrial unit, again, 3rd most popular. Our market has been starved of industrial because, it's been so easy to sell up to now. It doesn't come to the wider market. Agents tend to ping it off to their known buyers. So to get one in public with 6 bidders on it, I think the yield was 5.5%. So that's breaking the 6.2. That's getting below 6% because the buyers are being starved of supply. So that's really, really helpful, and that obviously implies rental growth.
Just picking up on yields, actually, from what you were saying earlier, there seems to be consistency across what you were saying in the commercial market, residential auction market, and what I'm saying where I'm dealing with privates in the student space, where the sort of golden position seems to be late 6-7% there or thereabouts at the moment. I was just interested that there's some commonality there between even these 3 very different markets.
Real estate is a yield play. So when you're buying a flat in Clapham at 2%, by implication you're assuming that the capital value is going to go up, and those days are a little bit gone for the moment.
Or you're borrowing for next to nothing.
And you're borrowing for next to nothing. You look at what the operators in the last 15 years have had it pretty easy. So I think there's not a wide acceptance that things are going to be hard. But if you're borrowing money at 7.5%, you really got to get those build costs right, and you've got to get a tenant right and the lease length right in our world, and get it all ticking nicely to get your exit with the profit you want. It's a change of position, and
it is. And I think
it's getting used to.
I think before we sort of round up and summarise, I think we accept, and as auctioneers, I always say this, we are and we accept we're a barometer of the market, and we're in a very privileged position to be able to tell people with fact rather than sentiment as to where the market really is. Back with sentiment as well, of course, because that's important. And there is a market there. That's the key leave behind for me, is that there's a market there. We've got buyers in the market. A lot of them are cash. Some of them raising debt after the event. And there's plenty of appetite. It is just getting the price right. And when we're in a buyer's market in all sectors, it feels like the best way for a seller to take control of that in our market, in the auction market, is to be aggressive with the price. And suddenly
so
you
have a
take
big
control.
flag out there saying there's a reason to buy this.
Yeah, and then suddenly you've got an auction. You've got 3, 4, 5, 6, 7, 8 buyers because you've created competition. And again, I know it's easy to say, but that's what's happened to us in the past few auctions. And the results
and our
speak for
sellers
itself.
are finding that and beginning to accept it. Turnover is right down in commercial markets across the board. We're no exception. But I feel it's coming back as sellers accept that it ain't what it was, and they may need to start trimming in their portfolios.
And we learn
There's always a buyer for it.
Yeah, and we learn a lot. We measure ourselves in lots of things, one of which is success rates. And our success rate in the last auction was, over 3 days, 86%. I can't remember it being 86% for over a decade.
It's almost unbelievable. Actually, I've seen the spreadsheet, so it's true.
Yeah, it's true. But I think it's key that we learn just as much from what we don't sell as what we do sell. And that's information we have. And we're happy to share and speak to sellers about what the market's doing, what it doesn't like, what it won't pay, but also we can demonstrate what it will pay. And that's really powerful.
Yeah, what's hot and what's not.
George, your print deadline, or we should say print, it's not print, launch deadline for your next catalogue's the same as us. How's yours shaping up?
Yeah, we've got a decent auction stacking up, really. It's probably a bit bigger than the last one. It's encouraging. Tesco's had their first dip into some leasebacks in the last auction, and we've got some more for them next time. Some Tesco's and one-stops. Interesting, Farm Foods, I think, first started auctions in 2003, and they've done occasional forays into auctions, but again, we've got a couple of leasebacks for them. So when those corporate sellers, say, right, let's offer some stock. There isn't much good stock around, so it's quite a nice indication of what we do, and let's say it works well. I think the buyers will be there. Things are stabilising. Interest rates, let's hope they're reaching that tabletop position when they're going to come down shortly. Who knows? But yeah, it's looking okay. Goes live on the 13th, Friday the 13th, same as yours.
Yeah, I know. What could possibly go
Why
wrong?
did we do that? Thank you very much, everybody. Final comments. Student sector is obviously here to stay. It's finding its feet. Is pricing stabilising? Is it improving generally?
Yeah, no, I think it's
black spots.
I think it's stabilising. I think there's good opportunity for those small lot sizes. There really is.
By small lot sizes,
yeah.
Are you talking 5 million?
Yeah,
or are
I'm
you still
talking
20?
5, 10, 2, even to 10 million. No, there really is.
So for some of our investors, it may be a good chance to diversify.
I think so. Yeah. Oh, no, definitely. Yeah.
And Richard, your take on? Just consistent.
Yeah, I think I sort of said it before, but the market, there is positivity out there. It's not all doom and gloom. There is a market in all sectors of residential across the country. Its pricing is the key, as always. Yeah. But I think it's a good time to buy, in my view.
There we go. I got him to say it.
I would say the same.
The time to buy is when it works for you. And I've just written a piece, actually, which will go live. But each individual investor is so different. And if they're all deal driven. So it used to be 50% were buying their local. Now it's 15% buying the local asset, because the rest of them are deal driven. They will drive to Carlisle and they will buy a cinema if they want to, because it works for them. I think that's really key. Each person's tax position, finance position, cash position is very different. And that's actually one of the joys of our market. I was just saying earlier to Cluffy, actually. So before I go, I must say, Harty, thanks for coming down from Leeds.
No, I've really enjoyed myself. Thank you for having me.
Good to see you. It beats doing this in a service station in Carlisle, which was what we did last time. And it's goodbye from me, George Walker. And if you'd like to give any feedback to the Allsop team, requests are always welcome. Podcasts@allsop.co.uk will get straight to us, and so we can include what you want to hear in the next round, which will be a little bit more of a commercial focus. Follow us on Spotify. Thank you for listening.